Good afternoon and welcome to today's podcast on tax-aware fixed income investing. My name is Matt Michaels. I am a co-founder and co-chief investment officer here at Fidelis Capital. Today's podcast is all about fixed income and our unique approach to investing in bonds here at Fidelis. Don't worry, this is not going to be a boring conversation on bonds. And our head of fixed income, Chris Gunster, is anything but boring. In fact, he was recently quoted as saying bonds are sexy again. For those of you who don't know Chris, he was the former head of fixed income portfolio management for all of Bank of America and Merrill Lynch. While he was there, Chris helped to oversee over $60 billion in client assets. He brings over 30 years of experience and has become a nationally recognized thought leader on all things fixed income. Chris has been quoted in Barron's, CNBC, Bloomberg, just to name a few of the publications. We're quite fortunate to have Chris as a partner here at Fidelis Capital. And I thought, Chris, a great place for us to start is you've been in the business quite a long time. I think it'd be helpful for our listeners to hear a little bit more about your background and your journey leading up to your decision to join Fidelis.
Thanks, Matt. Certainly, to get to your first point about bonds being sexy, yes, now is really a great time to be investing in bonds. And as far as my background goes, look, I've been in the business for over 30 some years, and I have seen the changes that the industry has gone through. I've seen the changes that markets have gone through. I've seen volatility high, I've seen volatility low, and we've seen low interest rates, we've seen high interest rates. We've seen a lot of changes. And now that I look at the market in terms of fixed income market where we are now, yes, now is the time for fixed income. And it's been a long time coming. And I think that's even more important now than ever to take a look at these markets and take a look at some of the nuances within the fixed income market. And you'll find that there's some very interesting things that are going on there. And some of the strategies that we're developing here at Fidelis, we've really taken it to a new level. And it really is a reflection of the current marketplace, of all of those changes that I've mentioned. Now is a great time to be looking at fixed income and to start thinking about different ways in which to look at the market. And here at Fidelis, we're able to do that.
I know a lot of today's conversation is going to be focused around taxable investors. And unfortunately, most of us are taxable investors. We do serve some clients that have tax-exempt status, but for individuals and families, especially those that have been successful like our clients have, taxes do matter. In my 25-year career as a portfolio manager and helping advise successful individuals and families, I've often come across investors or even advisors that seem to oversimplify bond investing, whether that's just, buy a bond at par and hold it till its maturity, or trying to make a decision whether I should invest only in municipal bonds or only in taxable bonds. Can you help to explain why oversimplifying investing in bonds is potentially a mistake?
Great question. So if I think about the fixed income market, and I've talked about the muni market versus the taxable market, look, to the extent that you are in a high marginal tax rate and you've been investing in municipals throughout the last couple of years or so, yeah, I mean, that is one way for those that are in the highest tax bracket. But I can tell you that if you dive into the details, to your point, if you avoid the oversimplification of fixed income, you realize that there are opportunities. In a nutshell, if you think about including the entire universe of potential fixed income bonds out there for those investors that pay a high tax rate and include corporate bonds, include treasuries, include high yield, include all of these other assets that are taxable, you will find that on an after-tax basis, some of those make sense at certain times. So I think to the point that you have oversimplified into avoiding taxes and just investing in munis only, that's not the most efficient use of your capital. There are opportunities in corporate bonds and in other taxable securities where if you just do the math, take a look at what you're going to end up in paying taxes when you invest in these securities. And at the end of the day, what's left in your pocket, and you compare it to your traditional municipal bond, you'll find that there are opportunities. And I think most advisors, most investors don't necessarily take that into consideration. And if you do, you will find some pretty good opportunities in those sectors that have traditionally been shunned by those managers and investors.
You know, Chris, I know one of the things that we've spoken about is just the inefficiency in the municipal bond market. When investors decide to only look at municipal bonds, there could be costs there. Can you give our listeners a sense of why the municipal market is perhaps less efficient than the broader fixed income market?
Sure, there's a number of different reasons. Let's talk about the players involved. Let's talk about the investors involved. First, in the corporate bond market. Look, it's dominated by what I would call professionals, right? Pensions, endowments, those folks that are professional investors in size looking to make a buck in the markets. And if I think about the municipal market, it's mostly a retail product. What does that mean? That is the individual investors. That is one of the key differences between the two. If there is a dislocation within the corporate market, the professionals will make sure through arbitrage to correct the mispricing, the misvaluation. Secondarily, the corporate bond market and the professional investors in that market are not subject to seasonal demand, seasonal investing. So if I think about the municipal market, typically it goes through seasons, okay? We all have to pay taxes. And come April of every year, you can almost count on it, that individual investors will start selling their municipal bonds to pay their tax. And then as you go through the year, there are other seasonal cycles where supply dwindles. In the municipal market, it happens during the summer. Demand still remains strong, but supply dries up. And then it happens again in what we call the January effect, which typically begins, I don't know why they call it the January effect, but typically begins November and December of the previous year, where again, supply dries up and valuations become tighter. It's almost like clockwork. The inefficiencies within that market, the seasonality, is one of the reasons why the municipal market is less efficient than the corporate bond market. In addition, the structure of the market itself, the municipal market has roughly 7 times the number of issuers that the corporate bond market has. You have very small issuers to very large issuers. It runs the gamut. Corporate issuance tends to be much more liquid and much larger. And as a result, you're going to get some inefficiencies. If you think about it, there are bonds within the municipal market that can go months, quarters, even years without a specific CUSIP being traded. The same cannot be said for the corporate bond market. So when you have those inefficiencies, you can take advantage of that. The relative value between munis and corporates changes all of the time because of the reasons that I just previously stated.
Thanks for that background. Moving on to the tax-aware fixed income strategy that you're helping to develop here at Fidelis Capital. Because we have to assign an acronym to everything, we've assigned TAFI to tax-aware fixed income. Can you talk a little bit, Chris, about what is TAFI and how is it implemented?
So if I think about the inefficiencies in the municipal market and taking advantage, that's what the TAFI strategy does. Over time, if you do the comparisons between the after-tax expected return, after-tax yield of similar bonds. So I take a corporate bond, I take a muni bond, and I group them into similar risk buckets, be it duration, be it credit quality, things of that nature. The TAFI strategy says, hey, if I buy this corporate bond and pay the tax, will I be better off or worse than that comparable muni bond? That, in a nutshell, is what it does. And it's an eye-opening experience for some investors because, hey, guess what? It's okay to pay the tax because at the end of the day, you have more money in your pocket. And I think that's a revelation that most investors, most advisors don't necessarily implement when they're thinking about fixed income. So that's one component. So if I go through the various risk metrics of credit quality and maturity and compare them, the muni bonds to similar corporate bonds, I can construct a portfolio that gives you the best after-tax yield comprised of both corporate bonds and municipal bonds. It's very labor intensive and it's very customized to that individual. So you're not going to see a lot of advisors offer this type of strategy because frankly, it can't be done on a scalable method. It's got to be done in a customized approach. And that's what we're able to do here at Fidelis. As you go through time, those valuations between corporates and municipal bonds change. And depending on the particular client, depending on their particular portfolio, you can capture those opportunities. But again, it goes back to a very highly customized approach.
Chris, aren't there other strategies out there that claim to do what we're talking about with TAFI? And if not, what are the differences? Why is this unique?
There are some that make an attempt to duplicate what we are doing. To the extent that they are able to do so, some firms use the trade-off between municipal and treasuries. When municipals, in their view, become rich, they move into treasuries. We take it a step further. We can actually look at not just treasuries, but as I mentioned, corporate bonds and mortgages and other securities. It's got to be scalable. And to the extent that these larger institutions with thousands of accounts attempt to do so, yes, they can. However, they're not really constructing the portfolios the most efficient manner in which they can. It really comes down to their inability to scale this particular strategy and offer it to a larger masses, whereas we can do it on a very singular, customized basis, because frankly, we have the capability to do so.
Yeah, and I just want to highlight that capability. Those of you that have spent the time to learn more about Fidelis Capital or are clients of Fidelis Capital know that the founding of Fidelis Capital was all about working with fewer families, working with fewer clients, being able to do more. The TAFI strategy only exists because of the fact that we're doing it with fewer clients. As an example, just this week, we had a number of calls with the tax preparers of several clients that are interested in starting to optimize their bond portfolios in a manner that Chris is talking about. And we dug into the weeds around what is that client's tax situation? What is the marginal tax rate? Would the client benefit from tax loss harvesting? How does that change over time? Because these decisions that need to be made in order to fully optimize them, they need to be account by account, client by client. We want to overlay our best thinking on sector and credit quality and where on the curve. And so that design to not scale this to the masses is what makes this strategy different.
Yes, and Matt, let me just add to that as well. And what that really involves is getting close to your client, knowing your client's current situation, and frankly, how it could change over time, because the TAFI strategy in one form may match the strategies of a particular client at a particular time, but it's flexible enough to alter its objectives, alter its investments to change with the client as we go through time.
So when we look at the current market today, where do you see opportunities as it relates to tax-aware fixed income?
Yeah, look, this has been a crazy year. This has been a crazy market. The last couple of years with the volatility, with the Fed increasing interest rates dramatically over the last year and a half, there is no better time period to really show the differences, the ability for the TAFI to outperform. And let's go back in time just a little bit, if we will. If I go back to where we were at the beginning of this year, and we looked at relative valuations between municipal bonds and corporate bonds, boy, municipal bonds were quite rich at the time. And to the extent that you were investing in fixed income at the time and you were buying municipal bonds, I would tell you that you were probably, if you were in a high tax rate, would have been better off buying corporate bonds at the time. Municipal bonds were that rich. Now let's fast forward to where we are now, and we're looking at just the opposite. Municipal bonds have become quite cheap, and corporate bonds, on a relative basis, have become quite rich. So what you're seeing here is exactly what the TAFI seeks to exploit, and that is that changes in the relative valuations, right? If munis become extremely rich as they were in January, if we have the opportunity and the tax advantage strategy to do so, we would be selling munis in favor of corporates. We go through, we fast forward where we are now, where munis are incredibly cheap relative to corporates. We would be buying at the margin the additional muni versus corporates. That's what it's all about. And frankly, there is no better time period than this last 2 years to show the volatility in the market, the interplay between those two strategies and the advantage that the TAFI strategy can take advantage of.
One other thing that's an opportunity out there, and I'd like your feedback on this as well, but many bond investors have been positioning portfolios for rising interest rates for some time. And as such, those portfolios might have shorter maturity structures or shorter duration structures. And now that interest rates have risen relatively quickly in a short period of time, many of those bonds are trading at losses. And one can make the argument that it's a good opportunity to harvest some of those losses, but also that it's a good opportunity to look to extend duration or maturity a little bit now that rates are much higher. And so I'd be curious if you had any thoughts around that.
Yeah, absolutely. Look, with bond prices where they are now, there should be no reason why you should not be harvesting losses to the extent that you want to offset gains somewhere else in the portfolio, or even bank some losses. And yes, other firms are doing that, and rightfully so. But what you should also be doing is, as you're harvesting these losses, take advantage of the opportunities that exist. You want to be adding duration. We've talked about that in previous podcasts in our outlook for the fourth quarter, where you should be adding duration. With yields where they are now in terms of absolute and real interest rates, there is no reason why we can think of that you should not be, at least at the margin, locking in some of the higher yields that are available in the marketplace, and doing so in the appropriate sector where relative value is showing you where to go. I already talked about munis being very rich. We are advising some of our clients that they should be looking to add duration, and to the extent that they are in our TAFI strategy, we're doing so by doing that in the municipal space as opposed to the treasury or the corporate space because of the relative value. So this market where you are right now is a tremendous opportunity for fixed income, and a tremendous opportunity to refocus, reanalyze, take a look at your fixed income, and really set it up for the next 3, 6, 9 months, 1 year coming forward.
Chris, you're a fantastic resource. We're fortunate to have you. Our clients are fortunate to have you. There's no doubt that you're helping to put the sexy back into fixed income. In summary, TAFI is a unique strategy. It is something that is not going to be available most places because of scalability, because of customization, and quite frankly, because of the experience that Chris brings to the table. If you have any questions, as always, do not hesitate to reach out to any member of your relationship team. And of course, we want to thank everyone for taking the time today to listen in and learn more, and then for the trust and confidence that you've placed in our team. We appreciate it. Thank you and take care.